Hello and welcome to this very special episode of Nivesh Befikar. Joining me today is one of India's finest and most respected fund managers, Sampath Reddy, who's the Chief Investment Officer at Bajaj Allianz Life Insurance. Thanks very much, Sampath. Always a pleasure talking to you. The first question, I'm sure everybody asks you, how are the markets looking? We are at over 35,000, but we hit 36,000. There was this bit of concern that we've corrected. Of course, in percentage terms, it was nothing, but you know how minds work. People think, oh my God, we are no longer in the place that we were in.
Right. For a long-term perspective, 3 to 5 year perspective, markets are still poised very well. Just that, last 3 to 4 years, we have not seen much of earnings growth. That's why most of the returns in the last 3 to 4 years was, mainly led by the PE expansion. So because of that, valuations appear to be slightly above the normal in terms of, long-term range perspective. But, since that, from now onwards, we are expecting the earnings growth to come back in a big way. FY19, we are looking at an earnings growth of upwards of 25%. From here on, earnings 25%. Largely that's because of the base effect. Last 3 to 4 years, what was happening was, the banking and the telecom and even pharma sectors were dragging the earnings growth of the aggregate market. So most of those issues are now behind. All of these things, will now going to contribute to the earnings growth from this year onwards.
When you talked about earnings, this was something which most pundits were finding very difficult to predict, right? Almost every quarter was the worst. Right. The worst is over, next quarter it's going to get better. Right. Are you saying that all the confusion of the last 4 years is finally over and we are going to see a strong earnings recovery from here on? Or is it going to be very select 1 or 2 sectors or a certain set of companies which will outperform?
It is largely, most of the sectors which were dragging the earnings growth in the past 3 to 4 years, they are coming to an end. Like, for example, even you take, for example, banking sector per se. Within that banking sector, private sector financials continues to do well, where they're growing upwards of 20-25% in terms of earnings. But the problem was with the corporate lenders, the NPA problem continues to be there. But if you look at, if you analyze their balance sheets, most of this stress has already been provided for, and incrementally, I don't think there will be a further risk to the earnings, and even in the corporate lenders as well. So they were dragging the earnings growth in the last couple of years, but now, pretty much all of that is behind. Another couple of sectors, well, let's talk about even IT services, for example. Whole of last year earnings, the dollar revenue growth was pretty good. 7-8% was there in terms of dollar revenue growth. But because of the strong rupee whole of last year, we have not seen, the IT services hasn't added any growth to the earnings. But now, with the, look at what's happening to the rupee. Now it's coming back to, it's a traditional, 3 to 4% per annum kind of a depreciation range. So that is again, IT services now with the rupee depreciation will begin to show the earnings growth. Pharma is still, was dragging earnings growth for the last 1 year, but I think still maybe they would take 6-7 months more because the US FDA issues are yet to be resolved. And, metals, which were again, with the globally commodity prices improving, even the crude rising, overall commodities are now looking up. And metals, which was again the drag in terms of earnings growth, they are also, pulling up the earnings growth of an aggregate market. So by and large, all of these areas where, where we were suffering in terms of earnings growth wise, they're all now behind. I think going forward, the other sector, consumer, it's always been a steady earnings growth. They will continue to be like that. But these one-off pockets where, which was depressing the earnings growth of the market as an aggregate, I think those are all now behind. So that's how we see that, earnings growth is more certain, this year.
Since most investors keep consuming a lot of media and maybe over-consuming, right. A lot of headlines which keep hitting us these days are more around the macros, right? Right. So as you mentioned, rupee, we keep reading X month low, Y month low, right. Falling, weak. Right. Current account deficit, oil, a big issue because, over $70, it's a big concern for the overall larger economy. Growth rate, while yes, expected to go up, we are still at about 7 to 7.5%. So a lot of these headlines, global factors, you keep reading about, conflict in certain zones, and because of that, markets reacting. So from an investor's point, the tendency seems to be to hear a lot of negatives. Right. You are still confident that this market will keep giving you good returns even for the next 5 years, for example?
Yes, absolutely. In fact, all of this macro started, appearing to be, deteriorated only in the last couple of months. Even our 10-year GSEC yield was 6.5, just about 3 months back, 4 months back. and today interest rates moved up by more than 150 basis points. Crude also, which was very comfortable level up until about 2 months back, now moved up to $80. All of these things incrementally have deteriorated somewhat. But if you go back and see in the last 10 years, what not has happened. You had seen Syrian war, you had seen Lehman crisis, you have seen all kinds of negative news that could have happened, several drought years, and policy paralysis. So many issues have happened. Brexit, all kinds of things have happened. In spite of that, last 7-8 years, 5-10 years, we have generated a very good return for the investors and from the market. Same is the case with the next 10 years also. There will be several one-off big negative events could take place, but that doesn't mean that the growth will take a step back. Yes, temporarily some today, if you look at it in the last 1 to 2 months, macro has slightly deteriorated with interest rate moving up, inflation inching up, and the crude going up. These are all temporary setbacks, but we'll all be able to adjust. The economy will be able to adjust these the negative developments, and we'll be able to move forward.
Some lot of exciting things happening in your space, right? Especially the whole new age 4G ULIPs, and you've been at the forefront as a company. You've been managing $8 billion.
Right.
So let me ask you the first question, since you made partly a reference about the last 10 years.
Right.
Now that we have a nice, decent window by which we can judge returns, would you say that ULIPs that have been managed by you or your team, what kind of returns have they given in the last 10 years?
Right. If you look at our own ULIPs, within the last 5 years to 10 years perspective, in spite of market return, Nifty return being somewhere in the ballpark range of 8-9%, 7-8%, depending on what time frame you measure, our ULIPs have generated approximately about 14 to 16% return for the customer at the NAV levels. The customer.
This is at a balanced portfolio, or
this is equity portfolios. This is equity portfolios, including 1 or 2 balanced funds also. But this equity portfolios have generated about 14 to 16% return for the customer, which is vis-a-vis, I would think market return of 8-10% in that range.
And this is tax-free return.
These are all, yeah. I mean, the ULIPs are having no taxation at the investor.
In fact, let me start with that, because that's what everybody is now getting excited about. That even with this LTCG of 10%, while equity direct or through mutual funds is taxed now at 10%, but ULIP is not taxed.
Not taxed, yes, right.
There's no LTCG on a ULIP.
I think this is one of the only financial investments which I think will have a favor on returns we don't have to pay taxes. Otherwise all bank related FDs and all other asset management products are subject to tax, whereas ULIPs continues to have the tax benefit. I think we rightfully deserve that, because the customer in the insurance space is really truly a long-term investor, and no customer can take away the money within less than 5 years. Even if he does not pay the subsequent premium policies, he will still not be able to take the money, or we could withdraw only after 5 years. So in that sense, it's a genuinely long-term savings for the for the smaller and poorer investors. I think the tax benefit is really deserving as well.
So as a fund manager of a ULIP corpus, how do you think differently from perhaps a fund manager, say, of a mutual fund? Because when you get money,
right,
and this is important to understand, because when we give our money to a fund house, could be an insurance company, or ULIP, or a mutual fund, they in turn are investing our money. So when Sampath Reddy gets the money, you know that for 5 years, nobody is going to come knocking and say, give me my money back. Does that change dramatically the way you invest?
Right. Certainly, I think, while investment professionals are fungible between the platforms, I could be tomorrow, managing money under the mutual fund platform, or vice versa. It could all happen. Having said that, given that the nature of the money that we have, the kind of customer expectation that we have, we generally tend to have a long-term orientation. Whenever we look at our investments, that's a key differentiator vis-a-vis typically other savings and investment products that are available. So our approach has always been to have a longer-term orientation because the customer is not looking at the return from a 3 months, 6 months perspective. He is judging us based on 3 to 5 year basis, how the returns have been. So that's where internally also our evaluation process is also geared up not just 6 months return, 1 year return, how is it, but how is our 3 or 5 year return has been. So overall, the philosophy and approach has always been to generate very good superior returns in the longer term perspective. That's that's what is our approach has been.
Just to get back on the same ULIP versus mutual fund issue, and I'm not going to ask you which is better, but just so that people can understand these products better, because there's a lot of comparison that goes on. Would you call a ULIP more like a fund of fund? Because here you buy one scheme, you invest in a scheme which is in turn investing in multiple funds. So if you could explain that, how does it work?
Yeah, it is actually, not really a fund of funds, but it's like a wealth management product, I would think so, because under, one particular product, you can shuffle your asset allocation based on, your risk appetite, based on your outlook on the market, all of those things you can do. Under one product, we offer, let's say, 8 different investment styles. One is a large cap equity fund, other is a mid cap equity fund, other is a flexi or a Sharia compliant investment product, and other is a balanced fund, and again a liquid fund, a bond fund, and a passive fund also.
And I can have little bit on each of them?
You can have a little bit of each of them. You can have
all in one.
All in one, or you can choose any number of 1, 2, 3, 4 investment style. Any number of styles you can choose, and also you can manage that the asset allocation without having any, I would say, transaction implication. It is not even, from the books of accounts perspective, you're not even transacted. You gave us money every year and you're paying regular premium. At the time of maturity or at the time of withdrawals, that's the only, transaction. In between, if you move money from large cap to the mid cap or mid cap to the liquid fund or a bond fund, any number of times you can switch, and, it will seamlessly move the money at the NAV to the NAV. And you can manage this asset allocation seamlessly without even any entry loads and exit loads, etc.
That's, in fact, to my mind, probably the best benefit that a ULIP gives you, because all financial planners will tell you that asset allocation is one of the most important principles of financial planning, and this allows you to move from one particular asset class to another depending on how the market has moved at a zero cost.
Absolutely.
There's no taxes.
There's no tax as well. Yeah. Even if you, let's say.
And are these switches free completely any number of times? Because I remember earlier, there used to be a limit. You can only do 3 free switches or 2 in a year, and
These are any number of switches. Only thing is we're saying 1 switch a day, because you
one
can't
switch a day.
Yeah.
Okay, so that's 365 switches a year.
Yeah. What it means is that you can't choose in the
don't
morning
don't overdo
and
it.
Go back to the day. Same. That's not possible. Otherwise, the next day you can do it. So at least
unlimited,
free of
cost,
free of cost.
No hidden charges.
No hidden charges at all.
Okay. Sampath, you've been with this industry for a very long time, and I remember 10 years ago there were a lot of concerns around ULIPs, in the sense that predominantly the charges. It was felt that 50%, 60%, 30% was your first year charge under multiple heads. There was concerns that some of these heads are not clearly or transparently told to you. How different, or how have we tried to resolve this problem through the new 4G, new age, whatever word you want to call it?
One is that the regulator was really proactive and brought down the charges to a reasonable level, reasonable intermediation cost level, and also they ensured that things are very, very transparent. And secondly, not only that regulatory push, but in addition to that, industry has also come forward and realize that the only way to grow is to make the product more and more attractive to the customer. I think that's the reason why you've seen whole host of the 4G, the new age ULIPs in the market. You've seen our own, the Goal Assured, which is one of the highly competitive in terms of expense ratio in the industry. We manage, and I don't think anybody's managing, the retail money in the equity platform at such a low cost, such a low expense ratio. I think that's been a huge welcome change for the industry. So the life insurance industry is now, geared up to, to be a very low cost, the distributor as well.
So if I was an investor in one of your earlier ULIPs, is it possible for me to migrate to a new age ULIP, or am I locked in for life with an old ULIP?
Yeah, I think once you bought the product, I think you have to stay for a minimum of 5 years, and after that you can, surrender that and withdraw that and come into the new age ULIP. Okay. So that's the only option right now.
But even in the old ones, things like switching, etc.
Yeah, the switching facility is there in the old one also. That switching is nothing new. I mean, it has been there, and it's just that,
instead of charging beyond a point, you're giving it now free.
Right. And even then, even in the old ULIPs also, the switching was not really chargeable.
Maybe originally when they came, there were caps and things like that.
Yeah,
that was reformed, you're saying.
Correct. Yeah, absolutely.
Okay. The other very popular route or method of investing, which I don't hear much from the insurance companies, more from the mutual funds, is the whole SIP, right? Systematic investment plan. Many think that SIP is another product, but it's actually just a way of investing. It's a methodology that you invest monthly. Do the new age ULIPs allow you to do that as well?
Absolutely. In fact, that's a good point. Typically the asset management industry was not SIP, about 5-10 years back. It was actually the insurance industry. All throughout, it was like SIP.
Always there were monthly premiums.
There were monthly premiums, even in a quarterly or a half yearly, a yearly premium. Regular interval premium paying is a sort of systematic investment plan. Even so, insurance industry has always been a systematic investment policy or a philosophy that we used to have. Even the monthly investment mode is also pretty much possible in all the ULIPs. I think that's not something which is which is new to the life insurance industry. We've been always taking the money systematically throughout the years.
And are you seeing a large number of your customers now preferring to do monthly rather than quarterly, half yearly?
Most of the customers under the the direct or online platform, they are mostly on the monthly platform. Wherever it's coming through the agency channels, that's slightly more skewed towards the annual mode.
So the new age ULIPs are purely online?
New age ULIPs are predominantly, I would say, online. I think we focus is on because the cost is such that we kept them more on the online platform.
So from the 60-70%, how much have they come down to?
60
in the new age ULIPs.
I think we're all gearing up to that. We've already come out with one new age ULIP, and we've a few more in the pipeline.
Where your fund management charge is 1.35%.
1.35.
And there's no other charge.
There are no other charges. Yeah.
In fact, there is also a giving back of the mortality charge.
Mortality, in our own the goal assured product, we are even returning the mortality charges to the customers at the time of maturity. So that's literally only the fund management charge of 1.35 is the only pretty much is the total cost that customer is experiencing.
Sampath, while when it comes to mutual funds, there is a lot of discussion and debate, comparisons, platforms where you can compare. How do I choose between one ULIP and another? Where can I go and see performance? And from again a transparency point, you used that word earlier. Is there a lot of disclosure that happens today? For example, portfolios, there is one criticism that the disclosures are not as stringent as mutual funds. Again, as a fund manager, you could, as you said, could be tomorrow sitting in a mutual fund.
Right.
Is that an area of concern at all, or do you think the transparency levels have gone up?
I do not think at all that's an area of concern. In fact, all the funds that we manage under the ULIP, or entire performance detail, portfolio holdings and sector-wise exposure, all of this data, like a fund fact sheet, is there in our website. And the customer, not only the customers, even other people also can log in and see how the funds are doing. The entire performance is also available on the website. So there's nothing which is not available. Of course, just that somebody has to do a little bit of research and need to find out. Otherwise, there is no I would say the disclosure norms, but I would say there's hardly any difference between the platforms.
And do you believe that platforms like, say, a Morningstar or a Policy Bazaar, do provide you adequate comparisons of
yes, in fact,
various ULIPs?
Morningstar has been rating almost all the life insurance products, the funds as well. Today most of our funds, almost all of our funds, we give the data. Entire data is available with all these third-party rating companies, and the data is all is even otherwise also it's publicly available. So from there they also rate all the insurance funds performance, and it's publicly available. So in terms of disclosure wise, I don't think there's any difference. In terms of the investment strategies and people and team and infrastructure, it's not a very expensive. It's not really that huge in terms of infrastructure. It's just a team of about 15-20 people. We also have similar, all insurance companies have a similar kind of an investment teams and stuff like that. There's no difference in terms of, infrastructure wise.
Just one last point, and I'm excited about this asset allocation piece a lot more. I remember that there was an option that you would give to investors that if you want us to do your asset allocation for you, we can do it for you. Does that exist, and how does that work?
Yeah, we have, in fact, there are different options that we give to the investors. One is customer can choose any of these funds and any proportion that he wants to invest. Otherwise, we also have, provide some trigger facility. If you want to keep us invested always between debt and equity, let's say 75-25 fashion, we can keep that maintaining, that same ratio between the two funds, throughout the investing period.
So my asset allocation is done
automatically. And also there's something called wheel of life. As you age over a period of time, if you may be investing with us for a 10 to 15 year perspective, initially you may fully invest everything in equities, but over a period of time you systematically want us to bring down to the the equities by the time the product gets matured. I think that facility is also possible. In a way, basically automated facility, or the investor's choice based decision making is also both the facilities are possible under the ULIP, any of the ULIPs that we.
So while there is a 5-year lock-in, as a fund manager, as someone who understands both equity and debt so well, for equity at least, what is the time frame that you would recommend? A lot of young people watch the Money Mile. What would you tell them? What is the time frame that you should look at?
I think minimum of 3 years. I think 3 to 5 years is a minimum time frame that equity investors should look at. Outside of that, it just it will be difficult for really to make the money. It's just even if somebody makes money, it could be just a mere sheer stroke of luck. But 3 to 5 years is a good time frame for any equity investors is the minimum to have. Normally, as I said, like in our case, minimum is a 5-year lock-in. There are investors with us, which are buying policies for even 10-year, 20-year as well. So that's really recommendable. Especially the young investors, should have a approach of more than 5 years, certainly. Maybe 10 to 15 years. But even otherwise, every individual's money in any which ways, either lies in the form of any of this financial asset, whether it is a liquid fund or a bond fund or a balance fund or a large cap or mid cap equity. We as a ULIP is giving you the entire gamut of financial savings platform. So in one scheme. So why do you need to think of suppose after 5 years you take out money from me, what will you do? I mean, unless you're consuming it for creating some other hard asset, it has to remain in the financial assets. So let it grow in the same, under the same bucket, under the same platform. So that's how one should look at it. Not just a 3-5 years, but as long as you're working or you're growing, the savings have to grow, and why not in the same the same platform.
Pleasure talking to you, Sampath. Wish you all the best, and thank you for coming down to the Money Mile. Thank you.